For Axel and CB, or this is a simple. What markets are pricing as a temporary oil supply shock is settling into a multi-year high energy price environment. Governments are responding by accelerating the renewable build-out at a pace nobody expected, neither priced in their models yet. If you look at our recommendation, BHP currently trades around $60. Our models value at $16, implying 73% downside. Meridian Energy trades around $4. We value it around $17, a 253% upside. I'll now hand it over to Axel to walk you through the catalyst.
Thanks, CB. Here's the shock the market hasn't fully priced. In early 2026, the Iran US Israel conflict closed the Strait of Hormuz, taking 20% of global oil supply offline. The market initially treated this as a temporary disruption, but after several rounds of failed peace talks, oil rocketed to $200 a barrel and has been oscillating between 170 and 220 for over a year now. Here's what the market is missing: the political consequence. Governments worldwide have quietly pivoted away from gradual decarbonization timelines toward urgent energy security. You can see on the right, Australia alone has accelerated state level renewable investments with billions flowing into projects in New South Wales, Queensland, and Victoria. This isn't a climate story anymore, it's a national security story. And that distinction is what creates winners and losers. For our short case, the thesis is simple. BHP is one of the most energy-intensive businesses on the ASX. Iron ore and copper extraction in the Pilbara region runs on diesel, gas, and grid power. All three are now structurally repriced upwards. In our shock scenario, power costs rise 4.5 times, eating roughly 65% of EBITDA. The market is still valuing BHP on historical energy norms. Sell-side consensus has not adjusted for the structural input cost reset. Moving to slide 4, the valuation. We've run an integrated three-statement DCF with a WACC of 6.78%, a terminal growth rate of 2.83%, and a beta of 0.84. The chart on the left shows our forecast free cash flow components. You can see the sharp drop at the shock repricing point in 2026, where the OPEX surge crushes the net income before it slowly recovers. The present value of forecast cash flows is 14.7 billion, plus a discounted terminal value of 69.4 billion gives us an enterprise value of 84 billion. Netting out that, we get an equity market cap of 82 billion across 5.08 billion shares. That's $16.21 per share against today's 60.46. That's 73% short. CB will expand on the long side.
Thank you, Axel. Our long thesis has three pillars. First, Meridian is 51% owned by the New Zealand's government. When energy security becomes a national policy, Meridian is in the first line for capital concern and great priority. Second, New Zealand's own electricity demand is projected to double by 2052. Meridian is the country's largest energy generator. They've already committed $2 billion in capital expenditure across 7 new projects expected to come online in 2029. None of these revenue leverages are reflected in the current share price. Now, to the valuations. WACC after tax of 5.7%, terminal growth at 4%, reflecting the demand doubling. Beta of just 0.3 due to the regulated government-backed revenue base. If we look closer into the figures, on the early years, with both public and private investments, Meridian invests heavily into new plants. And then we can see both net income and free cash flow head sharply upwards from around 27 and 28 as the new generation projects come online. With enterprise value of $45 billion and equity market cap of $44 billion comes around $17 per share against today's 4.8%. To close, let's zoom out for a moment. The cartesian skull is a scientific method to measure civilization technological maturity by their energy rate. Civilization with the scarf 1 harnesses all of its home planet's energy, and we sit around 0.72. The transition from heavy fossil fuel usage to renewable isn't a question of if, it's a question of when and who captures the value along the way. With every oil shock, the world realized having this much dependency on a single energy source is quite risky. Thus, we also have a need to diversify. In the short term, diesel-dependent miners like BHP are on the wrong side of the trend. The government-backed renewable generators like Meridian could give much better chance of riding the trend. Thank you.